Hello everyone, welcome to this year's 2026-2027 Budget Buster mini-series brought to you by Allegro Enterprises. We will be unpacking the budget speech that was delivered by the Minister of Finance on the 25th of February 2026. Today, we are looking at how market predictions compare to actual outcomes announced in the budget speech, and overall results were surprisingly stable and positive. Let's begin with personal income tax. After 2 consecutive years of no adjustments, the government has finally adjusted tax brackets in line with inflation. This is significant because it effectively ends bracket creep, where salary increases meant to keep up with inflation unintentionally push taxpayers into higher tax brackets. So while tax rates didn't increase, taxpayers are protected from higher taxation. This outcome was actually better than expected. Moving on to value-added tax, the VAT rate remains unchanged at 15%, which is aligned with market predictions. The positive relief comes from the increase in the VAT registration threshold from 1 million rands to 2.3 million rands. This is a substantial increase and provides meaningful relief to small businesses by reducing compliance burdens. It allows small businesses to grow before being required to register for VAT. This measure underscores the government's commitment to incentivizing small business participation in the economy by expanding targeted tax relief rather than broadening the general tax base through increases in VAT or personal income tax. Now looking at sin taxes and fuel levies. As predicted, increases were largely aligned to inflation. Cigarettes, wine, and spirits saw moderate increases, while fuel levies increased by 9 cents per litre for petrol and 8 cents for diesel. These adjustments were measured and aligned with fiscal expectations, meaning market predictions were largely accurate in this area. In terms of corporate tax and SME relief, the corporate income tax rate remains steady at 27%. The positive surprise comes in expanded small business relief. The capital gains tax exemption on the sale of small businesses by older persons has increased from 1.8 million rands to 2.7 million rands. The qualifying small business threshold has increased by 50% from 10 million rands to 15 million rands. This change is designed to reward older entrepreneurs who have built small businesses. It means they can retire with greater financial security, reinvest in other ventures, and pass wealth to their families, all while SARS collects less tax upfront. Another important development is in investment and savings. The annual tax-free investment limit for individuals has increased from 36,000 rands to 46,000 rands. This incentivizes long-term savings and wealth building by allowing households to benefit from greater tax-free compounding. This move supports financial resilience and reduces future dependency on state support. Now, let's address the headline surprise of the budget. The National Treasury withdrew the 20 billion additional tax that was expected following the medium-term budget policy statement. This means no emergency VAT hike, no new personal income tax increases, no new wealth taxes. This was the most significant positive deviation from predictions, and it will help in protecting disposable income. Overall, the key theme of the 2026-2027 budget is clear: stability over shock.